Alright, so in this video, I'll be trying something a little bit differently here. This is the 20s wealth blueprint. This is the 6 things I kind of wish I knew in my 20s. Looking back, I kind of wish someone would have told me some of this stuff to think about. And by the way, this is not financial advice. This is just for entertainment purposes. I think I'm going to be starting to do some videos like this, over some gameplay like this. Just playing old games I used to really enjoy. But starting with the first thing, I'm going to call it the invisible advantage. If you're in your 20s and you're watching this, there's one thing that you got more of than some of the richest people on earth, and that's time. Like, time is the only asset that you really have more of than like Elon Musk or Bill Gates. And having more time is huge, especially if you make a plan. So if you're like in your 20s, like 23, 22, maybe 25, you're probably hearing a lot of like stuff in your life. I feel like this generation has it harder than ever with all the information out there nowadays, especially with the internet. Like on TikTok, you're probably hearing about some random new meme coin. Your parents are probably trying to tell you to buy a new house, something you can't afford. And if you watch the news, it's always saying that the world's ending. So, but between now and the time that you hit 30, you have a superpower, and that's compounding. If you start investing money in your early 20s, let's just say you invest $500 a month now, by the time you're 60, you'll probably have over $2 million. If you wait till you're 35, that same $500 a month will be less than $800,000. So having all that time on your side really does compound. You can see calculators. If you look up an investment calculator right now and run it from like age 20 to 65 or even 60, you can see what $500 a month can do at like 8%, which is achievable. So don't procrastinate. And I'm not talking about just like not getting coffee going out to save money or stuff like that. Like really just dedicating a small percentage of your income every week, every time you get paid, and just putting that into like the market or some other asset that's going to build you wealth instead of just letting it go away. So one of the first points is, I want to call it the 75-25 rule. Pretty much for every 75 cents you make, every dollar you make, 75 cents you could spend. The other 25, I think investing 15% of it and then saving the other 10 would be good. Now this is assuming you already have you want to get an emergency fund of like 3 to 6 months, maybe 12 months of expenses covered up, and have that kind of sitting in a high yield savings account. That emergency fund is going to help you in case something bad happens. You're out driving, your tires go out, something like that. And right now you can get interest rates around 3%. So having a high yield savings account is going to save you a lot better than just having it sitting in a regular checkings account. Now when you have that cushion, you don't become like someone who panics. You don't have to go to work every day. If the market drops, you don't panic and sell your investments. This makes you stronger, makes you less fragile. So having that emergency fund is important. The next thing is the stock market. In the last few years, it's kind of been just like buy NVIDIA and chill. There's like the Magnificent Seven. Everyone's just putting their money in those big 7 companies. But I think as we head into 26, you're going to see a lot more rewards for the patience. Index funds really are king. If you're not the kind of person that wants to spend 40 hours a week researching, reading balance sheets, you can invest in something like the S&P 500. It's pretty much just a bet on the 500 biggest companies in the U.S. And historically, it's seen about like an 8 to 10% increase every year. Now, some years it goes down, some years it goes up, but overall, the average, you're looking at about 8% a year. So we've seen these mid-cap stocks start to go up, as well as the international stocks. They're starting to catch up with some of the tech giants. And I wouldn't be putting all your like eggs into one basket. Like AI is really popular right now, but you saw what happened in the 2000s with the dot-com bubble. Something like that could happen again. One thing I wish I would have done when I was younger was automate it, especially if you have a job that's like you know you're going to get paid X amount of dollars a month. You can just set it up where every time you get paid, $100 goes right into your brokerage account or whatever. But moving on from the stock market, and this is something that's really excited me this year. I actually was doing the math on it. I think I spent $350 just the other day on like $7.50 in dimes, which is crazy, but the dimes are made of silver. And this year, silver went up, I think 140% at its peak. Gold's up about 70%. This is crazy. This is really unusual. This isn't something we normally see, but I think having a small percentage of your portfolio in gold or silver is a good idea. Just as like a way to hedge against inflation. You know, some small percentage of it. Depends on how much risk you want to take. But really, historically speaking, like metals like this are real money. They're not being printed. Dollars are being printed every day. So the central banks have been buying gold like it's going out of style. It's technically an inflation hedge. When the dollar loses value, gold and silver tend to keep their value. And the silver isn't also just a store of wealth. It's used in industrial metals. You're going to see silver in your phone. The new electric cars have a lot of silver in them. And then solar panels have silver. As well as some of the military, like bombs and stuff. They put a lot of silver in those. Now, I don't think silver or gold's going to make you get rich. I think this year's been a very odd year. And I think there's a lot of factors playing into that. It doesn't pay dividends, but maybe having a 5 to 10% in physical metals might be a good idea. Now, the next one is Bitcoin. Yeah, some people think it's like digital gold. Some people think it's the ultimate trap. Seeing it at around 90K is like, a lot of people are thinking like, is this too late? This is like the big elephant in the room. Right now, I think Bitcoin's around 88,000 or 90,000, and it's down on the year, and it's actually down from its all-time high right now. I think it hit 126,000 this year, around October. But if you zoom out, it's still one of the best performing assets of the decade. And the reality check is Bitcoin's no longer just like a nerdy hobby. It's an institutional asset. BlackRock and Fidelity are now in the game. I don't think it's going to be as volatile as it's been in the past. I don't know about 100x in a week, but I think those days are gone. But I still think there's going to be a lot of volatility. You could be seeing like a 30% drop in a weekend. If you can't stomach that, I would just stay away from this stuff. But for most people, especially if you're in your 20s and you're aiming more for growth, I think some of the higher, safer cryptocurrencies could be something to look at, something like Bitcoin. Now, some people are all about the self-custody too, like not your keys, not your coin. I'm kind of interested what people think about that. Like, do you want to have it on exchange or not? And it's not something I'd put all my money into, but maybe 5%. Once I had that emergency fund saved up, just having some in there is like a growth fund pretty much. But in your 20s, I think being wealthy or chasing wealth isn't about like getting a Lamborghini to drive or something like that. It's more about consistency and imagining like if in 5 years you could just quit that job you hate to start a business. If you had enough money saved away and you have a plan, you could put some money away. And if you got some money to sit on, like 100K in a brokerage account, 50K, some gold in the safe and a little bit of Bitcoin, you kind of have the freedom fund to walk away from whatever it is. I think saying no to something is a lot more important than looking rich. Saving and investing isn't really for a Lambo, it's more for options. So if you have that option to walk away from something you don't want to do, that's a big thing. So if you haven't opened up a brokerage account or been thinking about investing, it's never too late to start. If you're in your 20s, I mean, the time is now. If you look at how much time you have ahead of you, if you could just put a little bit away every paycheck, this stuff will really start compounding, especially since you have time on your side. And that's all I got for today. Be sure to hit the like, leave a comment. If you made it this long, I appreciate you. And as always, stay tuned for the next video.